Good morning and welcome. Moss Adams is pleased to present today's webcast, Spring Ahead, New Regulations, Relief Initiatives, and Other Updates for Tax-Exempt Organizations, the members of Southern California Grantmakers, Northern California Grantmakers, Catalyst of San Diego. Before we begin, I'm going to play a brief housekeeping video.
Great. Thank you, everyone. Good morning. My name is Cameron Green. I am the Vice President of Professional Learning and Family Philanthropy at Southern California Grantmakers. I would like to extend a welcome on behalf of Philanthropy California, which includes Northern California Grantmakers and Catalyst of San Diego Grantmakers, along with Southern California Grantmakers, as well as SCG's Professional Learning Suite, Evolve. We are delighted to partner with Moss Adams for another exciting financial literacy program, and I'd like to take this moment to show our sincere gratitude to them for this continued collaboration. Please enjoy the program. Thank you.
Thank you, Cameron. Now I'm pleased to introduce today's presenters from Moss Adams, Lauren Haverlock, Senior Manager, and Ryan Stedman, Manager. And with that, I'll turn it over to Ryan to get us started.
Great. Thanks so much, Pam. Good morning, everyone. As Pam said, I am Ryan Stedman, and I know you all can't see us today on the webcast, so we thought we'd share just a few photos so you can get to know us a little bit more. I have been spending a lot of time outdoors, as I'm sure you all have been over the past year. And here are just a few positive moments I was able to capture this year. I've been practicing in public accounting for about 8 years and primarily have focused on advising tax-exempt organizations for the past few years. And I'm so happy to be here today presenting with Lauren. And I'll pass it over to Lauren to introduce herself before we jump into the presentation.
Thank you so much, Ryan. And here's my quarantine bio in pictures. So I'm a tax senior manager at Moss Adams. I've been here, been with the firm for nearly, I think it's like 4 years, 5 years now at this point, but I've been working with tax-exempt organizations for the majority of my 15 plus years in public accounting. I have spent my quarantine juggling the various tax changes and legislation, as well as 3 little kids. And so hopefully throughout the course of this presentation, it's pretty quiet in my house, but you never know when there might be a surprise appearance by a screaming child. So hopefully not. Things are pretty well managed, but we're really excited today to talk to you a little bit about updates in the tax world for nonprofit organizations. There's been so much going on in the past year related to legislation and other changes and grants and funding and all sorts of things coming down the pipeline that impact nonprofit organizations. And what we're hoping to do here is to kind of gather this information, take you through a progression of what's going on in the past year related to COVID, and kind of summarize where we stand today with some of our COVID legislation updates. On top of that, there are still other things happening with the IRS and in the tax world that aren't related to COVID. So we'll walk you through some of those changes as well. What's happening with the IRS? I don't know if many of you have interacted or attempted to interact with the IRS lately or have gotten notices from them. We'll kind of give you an update as to where they stand with a lot of things going on, as well as some other tax updates. There are other things happening in the tax world that aren't necessarily focused just on nonprofit organizations, but impact the industry, impact all industries that we want to bring to your attention. And of course, this seems like a world ago, but in 2017, we got the Tax Cuts and Jobs Act, which impacted nonprofit organizations in a sense, with a lot of the changes happening there. And so we'll just bring you around to kind of where those updates and regulations stand with relation to a couple things, focusing on the UBI silos, and excess compensation tax. So that's the format of today. One thing, I know a lot of the organizations on this webcast are grant makers. This is information that might not directly impact your organization as a grant-making organization, but it's really important to understand that this is the world that a lot of the grantee organizations and your peer organizations are living in, and some of the things that are affecting them. We also have tidbits of information that can impact you as an employer as well. So some thoughts about some different items and updates related to paid family leave and other credits programs that are out there, as well as certain benefits for employees that can come down the pipeline for your organization. So it's kind of a broad swath of information, and it's just nice to see where we all stand after such a chaotic year from a tax perspective, not even with the other chaos that we're all experiencing. We would love, through the course of this presentation, to get any questions that you have. There's a Q&A box, so please feel free to ask any question related to what we're presenting, as well as any other questions that you have overall if we don't address, that's not within this framework, because at the end we are going to leave some time for Q&A, and we'd love to have a more interactive presentation. Typically we do these live and in person, and we really miss that in-person interaction, so we'll take Q&A and use that as a replacement for the time being. So COVID legislation update. I'm going to kick this off with a brief walk through what we've seen over the past year. There has been deferrals to tax filings and payments, and we'll talk through where that stands in 2021 and what happened in 2020, because that impacts a lot of organizations. We have COVID declared a disaster, and this is really one of the first times that we've all seen where there is a national disaster declaration that impacts organizations not focused on geography or some sort of natural disaster that impacts a certain area. So there's been a lot of unique components related to that. You can see with the various rounds of relief how, there is some, 8.3 billion sounds like a lot of when it comes to the first round of COVID relief that happened over a year ago, March 6, 2020. But you'll see that progressed and escalated very quickly into $1 trillion relief packages. I believe on a recent AICPA call that there's been over $7 trillion to date that has gone out as through relief packages. And that's just an astounding amount of money, but a lot of that has come and hit organizations that are nonprofit organizations and employers, and hit a lot of organizations that really, really need it. So it's been very important, and we'll talk through what some of those packages look like high level after this summary. Recently, though, we've had a couple acts in March come down the pipeline, the American Rescue Plan Act and the PPP Extension Act. And we don't have this on here, but there's another one that we can see coming down with the Biden infrastructure, that Biden infrastructure plan, which is looking to be a $3 trillion piece of legislation that's going to be coming, or possibly be coming down the pipeline in the next couple months. That also includes a component of tax reform in it, and that is, I believe they're calling that the Made in America Tax Plan, and that's just recently in the past week been outlined in a little bit of detail. So we have some more tax changes coming down. The Biden relief, the Made in America Tax Plan seems to be focused on corporations and international corporations that are international organizations, working on vitalizing some of the international tax regime changes. And for nonprofits, that only impacts organizations that are invested in alternative investments that might have, other types of investments or NGOs that they control in other organizations. So, and then the corporate tax rate change might impact organizations that have UBI, but it's not really focused on nonprofits, hopefully. So we'll see when that comes down. So I think the only thing that we can know for sure that's going to be happening is that there's going to be a lot more change coming down the bend, which is, exciting and also a little bit stressful that we can't get, stability in our tax and what we're planning for in the tax world. So digging into the first item, deferral of tax filings and payments. In 2020, we saw with the April 15th deadline, this was when COVID really hit kind of big initially, and we had a lot of various shutdowns. And so the IRS did a blanket extension of filing due dates from April. Any filing that was due between April and July 15th, 2020 was all deferred until July 15th, 2020. So a lot of nonprofit organizations that had a May 15th deadline, they and others that were in between got a deferral of their tax, a push of their tax deadline to July 15th. The IRS at that time assured us all that their systems would be updated so that organizations wouldn't get notices. But we are seeing that a lot of organizations who took that payment and deadline deferral are receiving late filing notices from the IRS. In fact, we're seeing, and this is something we'll talk about when we talk through the IRS update, we're seeing lots of notices from the IRS when it comes to various impacts of COVID and their lack of ability to process paper returns and things of that nature. But this is I just brought this up as to organizations' attention that if you did defer, you could be getting a notice from the IRS regarding late filing, and that's just something that you'd want to work on responding to them with a letter. In 2021, there also has been a very mild, I suppose, deferral. Tax day for individuals has been extended from April 15th, 2021. There's a little typo, it's 2021, not 2021, to May 17th, 2021. So that impacts individuals' tax filings and nothing else. Really, anything related to a 1040 would be extended, although first quarter estimated tax payments for individuals is not extended. Corporate return due dates are not extended. So this is just really for individuals. It pushes it a month. And that's for systems to catch up and IRS to catch up on some of the changes that impacted 2020 individuals, specifically related to the first $10,000 of unemployment not being taxed to certain individuals. So that's why that push happened. Very limited, though. All right, moving on to the next, disaster relief payment. One of the things I mentioned was that there was a disaster declaration related to COVID-19, and that's a FEMA declared disaster. It's on the FEMA website. It applies to every state, and so if you go on the FEMA website, you can see the declarations by state. So what this does is this kind of opens up disaster assistance as a way to provide help to individuals. For employers, this means that you are able to provide tax-free assistance to your employees if it's under this cover of disaster relief. No substantiation is required for this. There's no dollar limit. It just needs to be reasonable and necessary. There's no discrimination testing. You can give it to certain employees and not other employees. And with that, no payroll taxes and no deduction limitations to businesses. That's more in the for-profit area. But we're seeing companies helping their employees through this difficult time by providing reimbursements for expenses that normally would be personal expenses and not, if a company reimburses a personal expense to an employee, it's taxable income to that employee. This is a way to kind of help your employees on a tax-free basis. So we're seeing caregiving expenses sometimes provided to employees, some sort of stipends or assistance to employees that have their children at home. Maybe they're doing schooling from home in a virtual environment. Medical expenses, funeral expenses, legal and accounting expenses. These type of expenses now, if your company has kind of a procedure for providing that type of assistance, can be given on a tax-free basis. Whereas before, as I mentioned, essentially if you give any type of assistance to employees, unless it meets very specific fringe benefit exceptions, it would be taxable income to that employee. Additionally, for private foundations, this also opens up assistance to individuals. Generally for private foundations, you are able to provide assistance to individuals for certain types. If those individuals are part of a charitable class, if you have approval to give scholarships and other types of assistance. And so this opens up disaster relief as another way to provide assistance to individuals through a private foundation without getting external approval or potentially having taxable expenditures. So this is a big benefit. The disaster relief is currently ongoing. When you go to the FEMA website and you check the state and the disaster, it says that it's current. It hasn't ended yet. We don't know when it's going to be considered ended from a disaster relief perspective, but if that's something that you're interested in, take a look online, and there are great articles out there that have best practices when doing this for your employees. So one of the first acts that we had come down, and this is, I think, technically the second round of coronavirus assistance, was the Families First Coronavirus Response Act. And what this was it provided, it requires certain organizations with under 500 employees to provide certain types of sick and family leave to their employees related to COVID-19. They mandated this type of leave that these employers were to provide, but it also allowed employers to get a refundable payroll tax credit in relation to this leave that was provided to their employees. So employees could receive up to 80 hours of paid sick leave for their own health needs or for others. They could also take family leave if they needed to assist, students or their children who were impacted by school closures or other types of daycare assistance. And so this had initially expired on December 31st, 2020, but the provisions have been updated with recent reform acts, including the ARPA Act, to extend this credit and this requirement to provide this paid family and sick leave to September 30th, 2021. So this is something that's still out there. There are certain entities that are exempt from this requirement, even if they have less than 500 employees. And so this is all governed under the Department of Labor. And we, of course, always encourage organizations, if you are wondering if you're required to provide this type of leave to your employees, to verify with their employment law attorneys and others to see if they fall under the entities that are required to provide this. And, if so, if you're required to provide it, you are able to get a credit. And what do the credits look like? The paid sick leave credit, we detail it out here. Employees who must self-isolate or obtain a diagnosis or comply with self-isolation requirements due to COVID-19 receive qualified sick leave credit. So employers who provide that benefit to employees up to $5,000, $110 per employee in wages. And then employees who have to take that leave to care for a family member who is sick can get it. There can be another credit for those employees up to $2,000, and it's 10 days, and it's based on a per employee per day. And this is detailed out here in this paid sick leave slide. For paid family leave credits, so if you need to take time, if nobody's sick in your family but an employee needs to take time off to care for a family member who's been displaced because of closures, and this is all something that seems like things are trending in the right direction now, so it may not be applicable this year, but it also feels like you never know when things can get rolled back a little bit. They're able to take leave, and you're required to provide them take leave, and you're able to obtain a credit for that leave capped at $200 per day for those employees. And this is under the paid family leave regime. So those are some great benefits to you as an employer if you have employees that need to take a step back. And we're at a quick polling slide, and so I'm going to pass it over to Pam to run this poll.
Sounds good. Thanks, Lauren. Yes, and here's our first polling question. My organization has taken advantage of either the paid sick leave credit or paid family leave credit. A, yes. B, no. C, not applicable. So I'll give you just a few minutes to respond. Again, to participate, just click the button next to the answer you choose, and then you can just hit submit. And again, this is for CPE credit for today's webcast. And then you'll need to respond to, we have actually 6 questions today because this is a 90-minute session. So you'll need to respond to at least 4 of the 6 polling questions. So I'll just leave it open for just a few more seconds, and then I'll we can take a look at the poll results. All right, I think I'll close it. I think we've got most of the responses coming through. All right, so here are the poll results.
Oh, so no one's taken advantage of that, which is either great because you haven't had any employees that needed to take time off, or you know, maybe you didn't know about it, but it's something that if you did provide time off, you are able to get that credit, and you can go back and retroactively apply for that credit on the 941X. So it's worthwhile to take a look at that to see if you can offset some of your payroll tax liabilities with this credit if you provided any employees with any leave time. Great, so we'll move along from that and we'll jump over to the CARES Act. The CARES Act we spent a lot of time on, and I don't have too much detail here because there has been a lot of provisions of the CARES Act that have been since adjusted and changed. So what we thought we knew back when the CARES Act came out in early 2020 has all been updated, and some of the kind of guidance on some of these programs have been changed. So the CARES Act brought us the Paycheck Protection Program, the expanding the EIDL and an emergency grant loan program, a mid-size loan program, which is the Main Street Lending Program, and the Employee Retention Tax Credit, among other things. But these were the great kind of big funding programs within the CARES Act. A lot of organizations took advantage. I think the Paycheck Protection Program ended up by being the most preferred way to get some sort of benefits. And so we'll talk through, after we go through this legislation, where the PPP stands right now. Same thing with the ERTC, since they have changed and evolved. But I have a couple slides for anyone who's interested on the mid-size loan program, the Main Street Lending Program. I'm not seeing a lot of organizations taking advantage of this program or the EIDL, honestly, but this is the Main Street Lending Program was something that is offered through the Federal Reserve Board, and basically wasn't previously available to nonprofit organizations, but in 2020, based on public feedback, they decided to expand the loan program to nonprofit organizations. It's not a forgivable loan. It is a repayable loan. So unlike the PPP, which is forgivable, Main Street Lending is not. Same with EIDL. Most of the EIDL loans are not forgivable, and we'll have a full comp schedule at that point. But just if you were wondering or curious, this is a little bit about the Main Street Lending Program. One of the other interesting benefits of the CARES Act was that it provided for payment of payroll taxes extended. So for organizations that had a significant amount of payroll taxes, one of the things that the IRS did, or that Congress did to help cash flow for organizations, is that it allowed organizations to defer their payroll tax payments. And they could have made an option to not calculate, but not remit the payroll taxes that they owe to the government, and instead pay those back at a later date. This is not a forgivable loan, but it ends up by being a interest-free loan in the amount of an organization's Social Security taxes. And so the payroll tax deferral is permitted for the 2020 year to be repaid at the end, 50% at the end of 2021 and 50% at the end of 2022. We don't have it here, but there was also an option that came down through executive order about an employee being able to defer their portion of their payroll taxes, and that was something that not a lot of our clients did because it wasn't mandated, but it was an option that employers could provide their employees. And it never was codified into law or anything. It was just an executive order that permitted that if an employee needed that cash flow benefit, that they could defer their payroll taxes as well. That wasn't a CARES Act. It was an executive order, and we didn't see anyone except for actually the federal government taking advantage of that for their employees. So with that, we have another polling question.
Yes. So here we are. The second polling question, my organization has taken advantage of the employer payroll tax deferrals. A, yes, B, no, C, not applicable. So again, yeah, we'll kind of leave this open just for a couple of seconds here to give you some time to respond to the question.
Yeah, and we didn't see a lot of, oh, go ahead.
Oh, go ahead,
yeah.
Lauren. Go ahead, Lauren.
I was just going to say, we didn't see a lot of our clients taking advantage of this payroll tax deferral because so many had the opportunity to get PPP funding or ERTC funding that they didn't want to go through and just kind of push these payments. But we do know some organizations that did have cash flow issues, very few, but that did take advantage of this.
Great. And then I think we got most of the responses in. So here, I'll go ahead and advance to the poll results.
Another overwhelming no. Well, it's good to know that if you do, and if you are looking at organizations that do have this liability on their books and you're curious if you're granting to these organizations, some are reporting this as a liability on the balance sheet, some nonprofits that did defer. So it's just good to know that this is something that it is required to be paid back to the government, but it's a cash flow kind of strategy that has been employed. All right, so for charitable giving, there has been some changes. There were some changes that came out of the CARES Act and subsequent acts as well. For one, there was the limitation on individuals who provide contributions to nonprofits was changed for certain contributions made to nonprofit organizations to be 100% of their AGI. So previously, if an individual contributed to a charity, they could only deduct up to a charitable contribution up to 60% of their AGI, but the CARES Act adjusted that to 100%. And this would be contributions to most types of 501c3 public charities. So it wouldn't be contributions to private foundations. And that was available through the CARES Act through 2020, but has since been extended to 2021. We do have a lot of individuals who are working on doing charitable giving planning, where they are taking a look at their personal private foundations and other nonprofit organizations and kind of working on ways to stack their contributions so that they get the biggest deduction possible, because there is an ability to stack and to kind of put an ordering for, I'm going to give some money to a private foundation and some money to donor advised fund and then some additional money to charity to try to get a deduction of greater than my typical limitation of 50 or 60% of their AGI. So we're seeing a little bit of planning on that end, and we're seeing our clients sometimes get involved in that type of planning. Some of our community foundations are working with their donors to see if they can get have contributions both to donor advised funds, but also to their general funds and like agency funds that they're not restricted or advised upon. So there are some planning opportunities that exist there. Corporations also have an increase in limitation. Typically, they've been limited to 10% of their AGI for a tax deduction for contributions, but it has been extended up to 25% of their AGI. So corporations can now give more, and this is whether to a private foundation or a public charity. They can kind of increase their charitable giving. A lot of our nonprofits take charitable deductions on their UBI tax returns. So this doesn't apply to nonprofits to offset their UBI. They still have that 10% limitation, but it is out there for other types of corporations. Some individuals now who don't itemize, now have a $300 above the line deduction. So it allows individuals who don't have, mortgages and property tax to itemize their deductions to be able to still get a credit for contributions up to $300. And we know there's been a lot of talk about extending that beyond, I think that one was extended to 2021, extending that to a higher amount and beyond 2021. And we've seen, generally some positive movement behind that, kind of a nonpartisan support of that. So hopefully we get something in some of these tax bills that come down the pipeline that expand the contributions for non-itemizing individuals. And then just really briefly, this doesn't impact all nonprofits, only ones that have UBI and NOLs, but there is now an ability for nonprofits to carry back their NOLs 5 years, and any other type of corporation or organization to carry back an NOL for 5 years, and that NOL carryback had previously been not permitted. Another cash flow strategy that the IRS is permitting organizations to take advantage of. So that was the CARES Act. There was a bunch there. In late December 2020, I think December 27th, we got the Consolidated Appropriations Act. And this was, an extender act, but it also had a bunch of different acts kind of lumped in together that also had some COVID relief provisions in there. So what we got in the Consolidated Appropriations Act is it created a second draw PPP loan program with kind of different parameters than the first draw PPP loan program. 501c6 organizations became eligible for the PPP program. Previously, it was just C3s. This expanded it to C6 organizations, extended the 2020 charitable benefits from the CARES Act, which we just talked about, extended the employee retention tax credit from 2020 to also applying to the first 2 quarters of 2021, and changed kind of what is applicable in 2021. It expanded the ERTC to those who obtained the PPP. So now entities who had a PPP can also get ERTC. It created something called the Shuttered Venue Operators Grant Program, which we'll talk about in just a second. And it extended payroll tax deferral repayments and emergency unemployment relief to those to individual taxpayers. Amongst many, many other things, these are just the most relevant in the nonprofit world. So the Shuttered Venue Operator Grant Program, this is something that probably is not going to be applicable to grant makers, but for organizations that you support, this has huge significance. And this is a new grant program that made $15 billion, and I think it's since been expanded, of grants available to shuttered venues. And the definition of shuttered venues is essentially any live performance operator, theatrical producers or production companies, performing arts organizations, museums, movie theaters, and talent representatives. So really anyone kind of in the performing arts space that has been impacted by COVID. So these entities, if they meet the qualifications, would be eligible to get a grant, and it's a non-repayable grant. It's not a loan, it's a true grant. And if they can show that they had a decline in gross earned revenue of at least 25% from 2020 to 2019. So this is a great program that we learned about in December, and finally tomorrow the grant portal is going to be opening for applicants. And the Shuttered Venue Operators Grant has a tiered application process. So the first applicants that are going to be allowed to apply are going to be organizations that had a 90% or greater reduction in earned revenue from 2020 to 2019, quarter over quarter. That's for the first 14 days. That's going to be who can apply at first. And this is a program that has $15 billion in funding. Once that's gone, there is no additional dollars available. So companies are scrambling to be able to get into this grant program. After the first 14 days, organizations that had 70% of reduction of earned revenues will be able to apply, and then after that, anyone who had 25 or more reduction in gross earned revenues would be able to apply. But it can, unlike the PPP, it can be used for a large variety of expenses: payroll, rent, utilities, mortgage payments, debt payments, independent contractor payments, leases, insurance, other types of ordinary and necessary business expenses. So, this is just something that's going to be, that I know a lot of performing arts venues, nonprofit, and also for-profit are looking to apply for and get starting tomorrow. So it'll be interesting to see how quickly this goes, who's available, who has access to the programming, and how that occurs. That was the big kind of new item from Consolidated Appropriations Act. And so the last act that we have that we're going to run through is what just happened in, I believe it was, I think I said March 11th, 21, it all kind of blends together, but what this American Rescue Plan did is it expanded the ERTC from June 30th to December 31st, 2021. So now the ERTC is applicable for all 4 quarters of 2021 if an organization qualifies. It expands PPP eligibility to large nonprofits, and previously it was only available to organizations who had a maximum 500 full-time equivalent employees, but now it changed that eligibility to large nonprofits with 500 employees per no more than 500 employees per locations. So a lot of organizations like Goodwills or YMCAs that might have a large network of various locations, but within one company might be able to apply for that PPP. SVOG applicants, previously in December it was stated that an SVOG applicant shuttered venues operator grant could not obtain additional PPP funding, but the American Rescue Plan changed that. Now they could get funding for both PPP and SVOG, but PPP funding would reduce SVOG funding, so it kind of created this interesting interplay with those 2 amounts. And then extended that tax credit, the payroll tax credit for paid sick and family leave to September 30th, 2021. And one interesting one that kind of interested me as a parent to young kids is it expanded dependent care assistance plans to allow employees to defer up to $10,500 for dependent care assistance, where previously the thresholds were $5,000. And this is something that, if you're able to do that for your employees, is a great benefit, not just for the employees to allow them to defer tax-free additional funds to help support their child care, but it also helps an organization in reducing your payroll tax liability, right? If you're letting employees defer some funds or some tax-free wages for child care, then it reduces your liability as an employer. So that is a really fast sprint through all the recent acts, and I'm going to send it over to Ryan now to jump a little bit more into where the PPP stands today.
Great, thank you. So we want to check in on where we are regarding PPP because, as Lauren has mentioned, there's just been so many updates to this program over the past year. But first, I just want to review, just for those who might not be aware, what PPP is to start us off. The PPP loan is a loan with debt forgiveness provisions, and it's available to not-for-profits in operation as of February 15th, 2020, and had paid employees and or paid independent contractors. It's generally available to not-for-profits that are employers of 500 or fewer employees per location. As Lauren mentioned, we'll get into the more specifics of what types of the different parameters around the different types of organizations. And the PPP is used to cover costs such as payroll, rent, utilities, mortgage interest payments, and then you can then apply for debt forgiveness for those qualified costs. And the major update for PPP for 2021 is that eligible organizations now have the opportunity for a second round of PPP loans, which we'll get into more specifics on the following slides. Some organizations who took advantage of PPP may now be applying for forgiveness. So we wanted to just provide also a brief update on that, in that lenders have 60 days to review forgiveness applications, and the SBA has 90 days to confirm. The SBA also released updated forgiveness applications and instructions through Form 3508. It's a series. There's a few of them depending on the size of the loan and activities of the organization. So within that series, there is a simplified forgiveness application for loans less than $150,000, and that's on Form 3508, and that's kind of a more streamlined and simplified forgiveness application. Those applications can be pretty daunting, so I was happy to see that they did release a more simplified version. The SBA has clarified that it will review loan applications over $2 million for adequate basis, and we'll talk about more detail on that in subsequent slides as well. And lastly, I wanted to share that on March 30th, 2021, the President, so just last week, very recent, the President signed the PPP Extension Act of 2021, which extends the deadline for submitting the PPP loan applications from March 31st to May 31st, 2021. And this was great to see, just an extension of the program overall, giving organizations more time to access those funds if they need them. And also, importantly, the Act also gives the SBA until June 30th, 2021 to process those and approve those applications submitted by May 31st. And I think previously the SBA was maybe cutting off those, or the loan processors were kind of cutting off the application deadlines to give the SBA more time to review and approve those by the application deadline. So that extension of the SBA review time was pretty critical. All right, moving on. The maximum amount of loan is calculated using the average payroll cost times a factor of 2.5 with either a $10 million or a $2 million cap, depending on if you're applying for your first draw of PPP or the second. So it's $10 million on your first and then $2 million on the second. And the amount able to be forgiven uses the 60-40 rule, meaning 60% needs to be coming from your payroll-related costs, and then the other 40% can be a mixture of the other qualified costs that we mentioned, such as occupancy costs, utilities, software, necessary supplier costs, fixing property damage from protests, PPE, and other COVID barriers. So, yeah, so it did cover a wide variety of expenses, but those expenses need to be less compared to your payroll-related costs. We can now have a choice between the forgiveness period, measurement period, between 8 and 24 weeks. I have another slide on that, so we'll talk about more on that in subsequent slides. And the reduction in forgiveness is based on a reduction in employees or wages. So this is important to kind of understand and track over the life of your loan. And also, it's important to know there are exceptions that exist for various hiring situations. And also, if the entity is unable to operate at previous levels due to shutdown orders. So it's not, you know, the end of the line for you if you did have to have a reduction in employees. So just be aware of that. And now we'll just go through the differences required for the eligibility between the first and second draw. The first draw of PPP is generally available to charitable organizations with 500 or fewer employees. And through the American Rescue Plan Act that Lauren mentioned, PPP eligibility is expanded to charitable organizations that have multiple locations and have more than 500 employees, as long as there's no more than 500 employees per any one location. So that was great to see. It's expanding to just so many more organizations. You know, the details and nuance of that is we're still trying to work out, but it's great to see they're continuing to expand those programs. So if we're talking about all the other types of exempt organizations other than the charitable types, they are also eligible for PPP loans if they have 300 or fewer employees per location. And there's an exception for C4 organizations, and there's also some limitations on lobbying activities and other certain types of exempt organizations, such as private clubs that limit the number of members for reasons other than capacity. So there are still some limitations to be aware of, but it was greatly expanded to other types as long as they have 300 or fewer employees per location. The maximum loan amount is the lesser of $10 million or 2.5 times the average total payroll costs from the 1-year period prior to the date of application. And it's based on economic necessity, and there is no gross receipts reduction requirement, as you'll see on the second draw of PPP, which we'll now take a look at. So certain organizations could now also qualify for the second round. The eligibility criteria differs from round 1 in a few ways. Previously, organizations could have up to 500 employees to qualify, and now they can't have more than 300 employees. And I believe that is per location as well. And the loan amounts are capped at $2 million per organization instead of the original $10 million. To receive a second PPP loan, organizations must have or will use the full amount of their first PPP loan before they can have access to the second. And as I briefly mentioned on the previous slide, organizations must show a decline in gross receipts of 25% in 1 quarter compared to the same quarter in 2019. And so that's a new thing to pay attention to for the second draw of PPP. And on the next few slides is we've prepared a reference chart for you to compare all the differences among all the loan programs under the various COVID relief acts. I don't want to go into too much detail here, but just know this is here for you to do a quick reference and comparison among all the programs. I thought the most helpful thing was the comparison between PPP-1 and PPP-2. So it was good to see those kind of in a snapshot next to each other. So we'll kind of breeze through these. There's a lot here, but it's a great kind of summary of everything. All right, moving on to the forgiveness period. So the PPP Flexibility Act, which was signed on June 5th, 2020, extended the length in the covered period for qualified payroll and non-payroll costs paid or incurred by borrowers from 8 weeks to 24 weeks. So now we have 2 periods that we can use to assess debt forgiveness, and there are advantages and disadvantages to both methods. The 8-week method is better for nonprofits who maybe had to let go employees early on in 2020. As I mentioned before, your debt forgiveness is in relation to retaining employees. So if you're letting employees go, you might see a reduction in the amount of your original loan that could actually be forgiven. And the 24-week method is advantageous for those who need just a little bit more time to accumulate qualified expenses needed for forgiveness, to rehire employees or reverse any wage reductions that happened during 2020. Unfortunately, it does happen. And if you do expect not to have your full loan forgiven, using the 24-week period would extend the amount of time you have to make those debt payments. So depending on where organizations are with their loan, they can kind of weigh the options. I know for the organizations we worked with, it was definitely a consideration, and we kind of had to help them through that calculation to see which one was more advantageous. The SBA has clarified that it will review or audit loans over $2 million. This is good news. It's good and bad news. It's good to know that they're looking at, specific threshold of loans, and they have given us a few clues as to what they're going to be looking at. They're going to be reviewing for adequate basis of certification, including reviewing economic necessity, ensuring proceeds were made appropriately, and that the calculation was also made accurately. In the case of the second draw, they will review if the organization did in fact experience that required 25% reduction in gross receipts. And they did say, you know, it's going to be presumed for all loans under $2 million that certification of need was made in good faith, but they always throw the, you know, the caveat in that they reserve the right to review any loan. So just because your loan is under $2 million doesn't necessarily mean they're not going to review it. They still might. And the SBA has a statute of limitations to reassess its forgiveness of 5 years. So keep aware of that as well. Keep all your documentation that long, which is important. And we've received actually a really great update in regard to whether expenses that were used for forgiveness of a loan would be in fact still tax deductible on their tax return. And the Consolidated Appropriations Act reversed the IRS's previous position that and it actually does allow taxpayers whose PPP loans are forgiven to deduct otherwise deductible expenses paid with PPP loan proceeds. So in other words, your forgiven loan is not taxable income. However, if you used expenses that were otherwise tax deductible to support your loan forgiveness, you can go ahead and still deduct those as normal on your tax return. It's not as applicable for tax-exempt organizations unless they have a loan that is related to unrelated activity, and this would be reported on their 990T, but it's still good to know. And I think with that, we're going to go into our third polling question.
Yes, thanks, Ryan. Yep, and here's our third polling question. My organization has taken advantage of the PPP, so A, yes, B, no, or C, not applicable.
I think you could also, maybe your organization hasn't taken advantage of the PPP, but maybe organizations that you're granting to, if you've heard of them taking advantage of the PPP, you know, that we could accept that answer as well. We just want to see, you know, what exposure you've had to PPP.
Thanks, Ryan. We'll just give them a couple more seconds here to be sure we get everyone's responses in. Oh, and then just a quick reminder for anybody who is interested, we've uploaded a copy of today's slide deck, so you can download that from the folder that says slide deck and handouts, which should be to the right of the slide view. And we'll also, we can also follow up with an email with the slide decks in case you have any issues downloading that. All right, so it looks like we've received, most of the responses. So here are the poll results.
Oh, good. Well, we have some yeses this time. That's great. Good. Well, I hope that's working out for your organization or for your grantee organizations. And for those that's not applicable to, that's good news too. Hopefully you haven't experienced any, you know, hard falls that you would need to take advantage of the loan. So, all right, great. So we'll move on to ERC. So we're going to discuss the 2020 ERC Employee Retention Credit and also the 2021 Employee Retention Credit. There's two different rules, so we'll go through each one. And just a reminder, the ERC is a refundable payroll credit available to non-for-profits who were fully or partially suspended due to COVID-19 related shutdown orders. For example, if your organization or your grantee organization was in in a place that had a shelter-in-place order, that might have been applicable, or the organization had a reduction of gross receipts of more than 50% when compared to the same quarter in the prior year. The credit is 50% of the first 10,000 wages plus health plan expenses for all of 2020. So the maximum credit up to $5,000 per employee for the entire year, for the entire 2020. An update we received in 2021, I think Lauren mentioned this, allows employers who receive PPP loans to claim the ERC for qualified wages, but only for those wages that are not also treated as payroll costs in obtaining the forgiveness on the loan. So you can't, there's no double dipping there, but it was fantastic news for organizations who had previously accessed those PPP loans. They're now eligible to go back and amend their payroll tax filing for 2020 and take advantage if they are eligible. And you can do this on a 941X. There's one for each quarter. And in fact, there's a little bit more guidance we have on this. On March 1st, 2021, the IRS issued notice 2021-20, it's a mouthful, that provides guidance for employers claiming the 2020 ERC, and included in that notice is guidance on how employers who received a PPP loan can retroactively claim that ERC tax credit for 2020. So if that's applicable to you, you can go back and read through the notice. The notice didn't have a ton of information outside of what they had previously posted on as an FAQ on their website, but I did read through it, and it did provide some really good examples that are actually really helpful. I actually did send a few of them to my clients, just explaining a little bit more about that. So if that's applicable to you, you can check that out. And a little bit more on the 2020 employee retention credit. So when determining eligible wages, we have to first determine how many employees there are. And employers with 100 or less employees, the credit is allowed on all eligible wages paid to employees, regardless of whether they are performing services. So that was very limited. We don't have a ton of organizations that have 100 employees or less. As you'll see with the 2021 credit, it's expanded to 500. So that was great to see. So if you're trying to claim the 2020 credit and you have more than 100 employees, the credit only applies to those who you paid who were not providing services due to COVID-19. So anyone who you're just basically keeping on the payroll just to continue to support them, but they're not actually providing any services to the organization. Okay, so now we'll turn more to the 2021. And as Laura mentioned, this credit was initially I think they issued it to June 30, 2021, and now they extended it for all quarters of 2021, so it applies for the entire year. And it's an allowable, the allowable credit percentage increased from 50% of qualifying wages to 70% of qualifying wages compared to 2020. The qualified wages per employee increased from $10,000 for all calendar quarters to $10,000 for any calendar quarter in 2021. And that increases the total maximum credit available per employee per quarter to be $7,000. So it would be, if you were able to maximize per employee, it would be a $28,000 credit per employee for 2021. So that's a major expansion of this, and I think this is one of the most successful CARES Act provisions, because it's we have seen some of our clients, mostly those who have a lot of minimum wage employees, such as museums or gardens, really be able to take significant amounts of credits towards their payroll tax filings. So I encourage you to kind of work through this if you think it could apply to your organization, or encourage any grantee organization to take a look at this. It's been surprising. I think it's surprising a lot of people this year with this expansion. So it's available to non-for-profits who are fully or partially suspended, again, due to shutdown order, or whose gross receipts declined by 20% when compared to same quarter in 2019. So yes, so that's basics of that. And then again, I mentioned compared to 2020, the eligible wages for employers with 500 or less employees is the threshold we're kind of working with here. So employers with 500 or less employees, a credit is allowed on all eligible wages paid to employees regardless of whether they're performing services. So this was pretty important to allow just so many more organizations to take advantage of this. And then on the next couple of slides, we just have another quick comparison chart of the 2 years of ERC for your reference. I think this was made before ARPA was passed. And so you can see on the left at the top, it's only really talking about January 1st through June 30th, but it really is applicable to all of the calendar quarters in 2021. So just keep that in mind as you're reviewing. And then same thing here, where it says the credit may be worth up to $14,000 per eligible employee. That is actually $28,000 per employee. And with that, I'll pass it back to Lauren to give us an IRS update.
Thank you. All right, so the IRS, what's going on with them? Well, they're still continuing to work through, they have work plans, they have compliance strategies, and those are continuing, on in the same method it has before COVID. But, outside of what we're technically seeing them market and what they're saying that they're going through, one of the things that we've been really, really working through is the IRS's internal delays. So just like many of our organizations, the IRS is also very impacted by COVID-19. Their employees, they went to a remote work environment, and I don't know if any of you all have dealt with IRS or gone through an audit or anything with them, but the IRS is not on the cutting edge of technology. We still communicate mostly with our IRS agents through fax machines and letters, and so IRS is still very reliant on being in the office, paper files, being at their work computers, and it makes sense because they do have concerns about, the security of the data, the very, very sensitive data that they have. So they had to pivot pretty quickly to a work from home environment. And, they did a pretty good job for an organization of that size. The one thing that they weren't prepared for, I think, was the influx of mail and how to handle the physical mail that they received. So as of December, I think around Christmas time, the end of 2020, the IRS had a backlog of almost 12 million paper returns from individuals and businesses, according to a report from the Treasury Inspector General, and this came out a couple of days ago. So that's just returns and filings. That doesn't account for letters and other correspondence that we've had with the IRS relating to, as I noted before, some of the notices that they've sent out, automatic notices for late filing returns, and other things. So this year we've had to deal with a lot of paper filings with that correspondence, especially since we haven't been able to get the IRS on the phone. So in many cases, if an organization has an issue, previously we would just give them a call, the IRS call, wait for 20 or 30 minutes, talk to an agent. That in the past year hasn't been as easy. The wait times, if you even are able to wait, are up to 2 hours. The agents, once you get on the phone with them, as a practitioner, the agent then needs a power of attorney, and oftentimes if they're not in the office or not accessible to a fax machine, or you as a practitioner aren't, you can't send them the information that you need, that they need to have for you to talk to them about clients. So it's been a very difficult year in coordinating with the IRS. We've sent more mail than normal. They've not opened the mail, and it's just created a bunch of delays. A lot of our clients had amended unrelated business income tax returns because last year Congress repealed the parking tax for nonprofit organizations. So a lot of our clients had paid some tax, submitted a paper file 990T requesting a refund of that tax, and we haven't seen a lot of refunds coming down the pipeline because it seems like the IRS hasn't processed a lot of those returns. So one of the ways that they're addressing this is to strengthen their operational efficiencies and technology. They are working on accepting more tax returns electronically, and that's something that Ryan will touch on briefly with other tax updates, because that does impact a lot of organizations that have paper filed in the past and relied on being able to print and submit a tax return to them. They don't have access to electronic filing options, but they are expanding that, and they're trying to become more a taxpayer-focused organization. With their examinations, they've been very targeted, and they're not having general IRS audits like they have in the past. They're focusing them in on more specific items. So what does the IRS's compliance strategy look like? They are looking, of course, as always, at worker classification as well as employee plans. So benefit plans for small employers and large employers, ensuring that you're complying with your requirements as to who's allowed to participate in your employer plans. If you have a 403B plan, we're seeing a lot of 403B plan audits. They're looking at other types of income for self-employed plans and participant loans. They are looking at excise tax on excess compensation. That's something that they've made a couple changes to the Form 990 to more easily be able to identify organizations that are paying over $1 million in compensation and whether those organizations are reporting those taxes. They are looking also at arbitrage violations for tax-exempt bondholders, as well as Form W-2 and 1099 matches. As always, worker classification and income tax return or information tax returns like W-2s and 1099s are very low-hanging fruit from the IRS. They find that if there are any issues with those, they are pretty easily able to get penalties and correct those types of reporting requirements. And so that's something that we see them constantly looking at. A couple other new things that they announced this week is that the IRS is looking at two new initiatives. One is whether any executives of nonprofit organizations are reporting Schedule C or Schedule C filers for their 1040. So do any executives of a nonprofit prepare Schedule C, on their individual tax returns as though they are a self-employed individual, and are they taking business deductions against the income that they're getting as a officer of a nonprofit organization? So they are running those analytics of those employees that may not, first of all, that's two issues: worker classification. Are your officers, are you classifying officers as 1099 contractors versus W-2 employees, and are they taking deductions against their taxable income? The other one is they're looking at 990N filers and whether 990N filers truly have under $50,000 of gross receipts. So those are a couple new areas they're looking at this year. They do have a priority guidance plan, and they have worked on a lot of guidance relating to UBI silos, which we'll talk about briefly later on in this program, as well as the final regulations under excess compensation. Some other things that we're expecting down the pipeline is group return, information about group return filings, as well as donor advised fund guidance. So donor advised fund is of acute interest to the IRS. They're looking at providing some sort of guidance on that. A lot of stuff that could impact private foundations that grant money to donor advised funds. for which the private foundation is the donor advisor, nonprofits who receive funds from donor advised funds and how that affects public support. There's a lot of stuff going on in that area, and fund management as well. But with that, we'll jump a little bit more into some of these tax updates. And I know that we're running into our last 20 minutes of time, so we might breeze through some of these a little bit, and some of which I've already addressed briefly. But I'll throw it over to Ryan for these items.
Great. I'll just quickly run through some of these non-COVID related tax legislation updates that you may or may not be aware of. We were all thrilled when the Taxpayer Certainty and Disaster Act passed, which retroactively repealed the famous parking tax. And good news from this is that we're just starting to see some of those refunds roll in from our clients who had actually filed the amended return to request the refund of those taxes paid. So if you're still waiting for yours, do not worry, you're not alone. As Lauren mentioned, the IRS is really backed up with paper filed returns and correspondence from 2020, so you can continue to expect delays on the refunds. And I think we have polling question number 4 related to that.
Yeah, well, thank you. Yep, here's poll question 4. Have you amended your 990T to claim a refund for the repeal of the qualified transportation fringe benefit? A, yes. B, no. C, should I? Or D, not applicable. So again, we'll leave this open, for a couple of seconds to give you some time to respond, to this poll question. It's looking like we've got almost, most of our responses submitted. So I guess, we think we can advance to the poll results. Here we go.
It's not applicable for most organizations, which makes sense. If you're not paying for those parking benefits for your employees, you're not going to have this be applicable to your organization. Probably a lot of your grantee organizations this applied to. A lot of our clients were dealing with this headache, and we're happy to see it go. All right, moving on. As Lauren mentioned, IRS is making efforts to modernize its technology, and with that, we have updated e-filing requirements. So the Form 990 and 990-PS must now be e-filed for years beginning on or after July 2nd, 2019. We can e-file for organizations with exemption applications pending for organizations filing in their 2020 tax return year. Organizations will also be required to e-file their 990-PS and Form 4720. And also, there is a slight delay for 990 EZ filers if it's going to cause undue burden for the organization. And then finally, Form 1023, which is the application for tax exemption, is also available online through IRS website pay.gov. The Secure Act provision, this affects private foundations with tax years beginning after December 20th, 2019. The excise tax rate on the net investment income is now a flat 1.39% instead of that variable 1 or 2% rate that had applied before, depending on the average distributions of the private foundation. This makes planning so much easier, but it may, not be as advantageous for organizations who are consistently in that 1% rate. But I think overall, I've heard some positive things about securing that flat percent. Donor advised funds, as Lauren mentioned, there's really a lot of increased scrutiny around these donor advised funds. So we're expecting a lot more guidance in the areas of allowing a donor advised fund distribution to fulfill a donor pledge or attendance at a charity event. There might be additional donor reporting to public charities, which would affect their public support test. And also they're looking at limiting a private foundation's giving to donor advised funds. I think Lauren mentioned all of this, so I'll just kind of skip ahead. And all right, a quick update on AB5, which is the California new standard for classifying workers as either employees or independent contractors. They created a new test that now ropes in more individuals in the definition of an employee who previously could have been considered an independent contractor. There was a layer of complexity added in November 2020 where California voters Proposition 22 was passed, which allowed the app-based transportation and food industry workers such as Uber or Postmates to be carved out of this test, and so they're exempt. But the law went into effect on January 1st, 2020, and so if this applies to your organization and you haven't taken a look, you might want to. Other topics, I'm not going to spend too much time here. Most notably, I think, is the IRS Form 1099 NEC replaces Form 1099 NISC for Box 7 of non-employee compensation reporting for 2020 payments. And those forms were due in the spring of 2020. So hopefully, if this applies to your organization, that this is already taken care of. And if not, maybe once a week, reach out to either your payroll provider or your advisor to assist. There were some changes to group exemption filings, and if you don't know what a group exemption filing is, it's just basically where a group of affiliated organizations are recognized as tax exempt under one ruling if they're affiliated with one central organization, and this just avoids the need for any individual organization to apply for exemption. And there are some changes here applicable to the central organization who are seeking or maintaining these exemptions. And Moss Adams actually has published many articles, an article about this, so if you're interested in learning more, you can check that out. And lastly, in this section, we'll briefly talk about remote employees, and this is something to consider if you're still working remotely and have employees, scattered amongst all over the country, and you want to make sure you know your employees have established a residence because this could influence your state withholding obligations for payroll taxes. And we've provided the resources here through AICPA and state agencies, so feel free to reference those or pass that along to any organization that it might be applicable to. And I think we'll do like a quick TCJA update. I think it seems like ancient history at this point, but we'll do a quick snapshot. So we've already touched on the parking tax repeal, and we'll also give an update on SILO, UBI rules 512A6, of course, and then Lauren will touch on the excess compensation because they both had final regulations issued this year, so want to just give a brief update on that. And then for the excise tax on private colleges with very large endowments, we're not going to touch on that today. It's a very narrow sector of organizations of private colleges, so we didn't think it was applicable today, but just know it's out there. All right, so just a reminder of what 512A6 brought us. We now must separately compute net income for each trade or business activity that an organization carries on. So this is applicable for tax years beginning after January 1st, 2018, and we are no longer allowed to offset losses from one activity from income activity from another. So this concept is commonly referred to as UBI siloing, so you may have heard of it. Be referenced that way. And final regulations for 512A6 were issued late last year. It generally follows the prior guidance provided in the proposed regulations, but there's some notable differences. So the general rule under the proposed regs calls for a standardization of coding using the 2-digit NAICS codes to identify a separate trade or business. The exception is for activities described as qualifying investment activities, which we'll kind of touch on in a bit. The final regs clarified that the determination clarification of which two-digit code is based on the more specific NAICS code, that's of the 6-digit NAICS code, and I'll show that list here in a second. And also, which was good news because we were asking about this, the final regulations clarified how the silo rules affect the public support test and basically says you can use any method when determining what UBTI to report on your public support test on Schedule A. You can either aggregate or you can use the silo rules to determine, and it was never in their intention to affect public support. Here are the two-digit NAICS codes. You can find them on their website. And so this would be your grouping for any unrelated trade or business other than investment activities. The final regulations did not fully address the expense allocation issues, and they plan to issue separate guidance in the future. So stay tuned for that. And they did incorporate the existing allocation standard and states that organizations must allocate on a reasonable basis, and using the gross from gross method is not an acceptable method. It clarified that charitable contributions are not calculated for each silo activity and instead are taken in the aggregate of all silos. So that was, I was happy to see that. It was just too confusing trying to allocate those charitable contributions among all the activities. And also they did some changes and clarifications regarding the order in which you take pre and post silo NOLs. And basically the unsiloed NOLs, you take the unsiloed NOLs before deducting any silo NOLs. And so they did not change the aggregation rules for the quote-unquote investment silo too much from the proposed regulations. So it's still kind of the same where you have your QPI and your qualifying S-Corp interest and your debt finance income being aggregated into your investment silo, but it did kind of change some nomenclatures. So instead of the control test, it now refers to it as a significant participation test, but the factors are kind of really similar to the proposed regulations. So we won't go into too much more detail there. And the final regulations expand a favorable look-through rule under the proposed regulations that permit an indirect interest in a lower tier partnership that meets a de minimis test to be treated as a QPI, even if the organization significantly participates in the directly held upper tier partnership. That is a mouthful, but the example here kind of illustrates it, basically saying that there's this indirectly held partnership A, that would be considered a QPI because when you, after applying that 50% ownership level of the exempt organization, it is at or below that 2% de minimis threshold, and so that particular lower tier entity is considered a QPI, but B would not be because it doesn't meet that de minimis test. So hopefully that helps. It is kind of confusing. And with that, I think we'll go to our next polling question.
Yeah, thanks, Ryan. Yep, and here's our fifth polling question. How excited are you that you no longer need to ask disqualified persons about their investments? A, I'm ecstatic. B, that's nice. C, wait, I was supposed to do that? Or D, didn't apply. So again, yeah, we're kind of getting close here to kind of wrapping up our session today, and really thank Lauren and Ryan for just all of this information that they're presenting today. So we'll just kind of give a few seconds here for everyone to respond to this poll question. We've got one more polling question to ask here in case you need CPE credit today, and in case you missed a poll question.
Yeah, and you don't have to get this right. Any answer will do. I don't think we really talked about this aggregation of disqualified persons and their investments, but basically in prior guidance, they said that you would potentially have to incorporate investment percentages of your disqualified persons in conjunction with the exempt organization, but proposed and final regulations say that that's not required.
All right, and here I'll go ahead and close the poll, and here are our responses.
Great! Oh my gosh, I'm ecstatic too. Whoever answered ecstatic, I'm ecstatic about that, and yeah, I'm glad that some people are finding it positive. All right, I think with that, I'll turn it over to Lauren to just wrap up with excise compensation briefly, and then I think we have one more polling question to get through before 11:30.
Thank you. So the excess compensation was something that was really concerning to a lot of the foundation and grant makers that we worked with, especially those that are related to corporations or other types of for-profit organizations. So what the excess compensation and parachute payment rules said was that the Congress imposed a 21% excise tax on a nonprofit who paid compensation in excess of $1 million or excess parachute payments to any of an individual who'd be considered a covered employee. Where this got a little bit nerve-wracking for organizations is as the code was written, it applied to remuneration paid by the nonprofit and any related organization to any board members, officers, directors, or trustees. And so a lot of our corporate foundations stopped and said, well, okay, we have a related company and, the president of our company, sits on our foundation. Now do we have to take a look at that compensation that person's getting paid to be an employee to our company as part of this excess compensation tax? The way that it was written, it seemed to be that could be the case. Fortunately, though, since that time we've gotten some proposed regulations and final regulations that clarified what was meant to be in that particular area. So for this tax, anyone who's a nonprofit organization, public charity, private foundation, and any other types of organizations that are exempt under 501A would be subject to this excess compensation rule. And the tax is on the nonprofit organization, filed on a Form 4720, and calculated as an excise tax, not an income tax or anything to that effect. So what the final regulation stated, and it stated a lot of things. There were hundreds of pages of the final regulations, but relevant to a lot of our foundations and grant-making organizations is that, it covered employees who would be considered for this excess compensation rule is anyone who's a top 5 employee in any year since 2018, essentially. If that person was paid as a top 5 highest compensated employee from the organization, factoring in the organization's compensation and any related organization compensation, they get on a list of covered employees, and it's any 5 throughout the years. But what happens is there are certain exclusions. So individuals who don't have to be counted as covered employee would be volunteers to the tax-exempt organization, provided that they give no more than 10% of their total hours to the nonprofit organization, or they have fewer than 100 annual hours of services, or they're not paid or they don't have an employee contract with the nonprofit. So that made a lot of our foundations breathe a sigh of relief, understanding that they needed to track certain information to help support. They don't need to account for any compensation paid to board members, officers, directors from any related for-profit organization and as applicable to this tax. So, remuneration and looking at that, if you do have to account for a person, it would be essentially looking at that person's W-2 compensation, wages, and not certain exclusions from that compensation. So that's just something to be aware of and to track internally, although we don't have a ton of organizations in the grant-making space that are dealing with this level of compensation. So that brings us to our final question, and I'll throw it over to Pam for that final question.
Yep, here's our last polling question. My organization is tracking covered employees. A, yes, B, no, C, not applicable. And again, this is our last poll question, so yeah, just give you a few seconds to submit your responses.
Yeah, and technically the way that it's written is that all organizations need to track covered employees just in case that employee ever makes more than $1 million or receives an excess parachute payment. An excess parachute payment would be like a severance that is over 3 times an employee's base compensation. Those are such extraordinary events that most of our clients are reverse engineering. You know, if they do ever have somebody who receives a severance in excess of 3 times their base compensation, or if their compensation ever hits $1 million for any type of reason. And those reasons could also relate to, you know, 457F plans or other types of deferred comp plans. Then they'll go back and see if that person ever was a covered employee, rather than tracking in the rare case that they have one of these compensation events.
And here are the results, Lauren.
Wonderful. Great. And that brings us right up to our time. You know, we don't have time for Q&A, but I know we covered a broad amount of information. Ryan and our contact information is here. If you have any questions on any of these items or anything else going on, we're always happy to discuss any changes with you all. So I'll send it back to Pam to close out this session.
Yes, thank you so much, Lauren and Ryan, for a great presentation today. And just as a reminder, if you attended today's presentation in a group and would like to receive CTE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, you should be able to download a copy of your certificate in the CTE progress window to the right of the slide view. I'll keep this webcast console open for a few minutes to give you time to download your certificate, and then a copy of your certificate will also be emailed within 3 weeks should you have any difficulty downloading it now. And then finally, here's a link to a survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us and to SoCal grantmakers as well, as we continue to brainstorm additional topics and ideas that we think would be relevant to you. So we look forward to hearing from you. Again, thank you so much for joining us today, and hope you'll join us again next time.